I'd like to start this particular recording with a book recommendation because tax is usually the last thing that many people think about when they think about investing in cryptocurrencies. Most of the time, people either are very optimistic and think about the profits they're going to make, or they think about the losses that are going to be incurred in this risky asset class. So people are either one of two extremes. Now, obviously, if you do make a profit, you are going to have to pay some tax on it. And the worldwide situation is forever improving the tax demands of cryptocurrency trading. So, this book, The Joy of Tax, actually reframes some of the tax paying experiences, and it's particularly UK centric, this book. But if you read it, you'll be able to find out why we pay tax and how it benefits society, which may help if you are going to be paying quite a lot in taxes as a result of crypto trading. Now, obviously, naturally, the more tax you pay, the more profit you will have made. Okay. And one thing that I want to overarch this entire presentation with is the fact that profits obviously negate losses. Okay. And vice versa. Losses negate profits. So if you happen to have a string of losses, then it's a good thing that you are paying tax on that because that is then tax deductible. Now, I am not a tax lawyer, I am not an accountant. This is a general overview of the tax situation at the time of recording, which is in September 2021, of the current circumstances on tax. Now, this is a rapidly evolving field. Indeed, only a few years ago, there were no tax rules, and the UK was actually one of the first to implement tax rules. The majority of governments worldwide actually treat cryptocurrencies as property as opposed to currency. Now, that situation may change. In particular, El Salvador has made Bitcoin legal tender, and therefore it is now a currency as opposed to a unit of property in that country. And as cryptocurrencies become more adopted over time, we may find that they are treated as currencies as opposed to property. But for the moment, for the time being, most jurisdictions regard cryptocurrency as property. Now, in the UK, which is the place where I'm from, I'm going to be talking specifically about the UK law in this video. I'm also going to be referencing the US, but the US is a lot more complicated and a lot more state dependent. Some cryptocurrencies are illegal in some states, others have very relaxed tolerance towards cryptocurrencies, and vice versa. Indeed, cryptocurrencies are illegal entirely in some countries around the world. So if you're watching this, make sure if you're going to be trading cryptocurrencies that they are legal in your jurisdiction and they are legal in your territory, or find some way around it. But if you find some way around it, be prepared to feel the wrath of the government if you do happen to make a profit and publish it in your returns. So let's have a look at some advice that we can get for free on crypto asset tax. This is Comply Advantage, and this is a list of cryptocurrency regulations, just an overview basically of cryptocurrency regulations in these particular countries. Now, these don't go in depth particularly, they just give you a general flavour, a general overview of the tax circumstances. We're going to look at the UK one now. Okay, so in the UK, cryptocurrencies are not legal tender. They are provided through cryptocurrency exchanges which are legal, and they are required to register with the FCA for anti-money laundering purposes and etc. Know your customer, basically. Okay. So the UK's approach to cryptocurrency regulations has been measured, but they were the first. UK was one of the first to actually impose a tax framework around cryptocurrencies, and they started a task force back in 2018. Now, that doesn't necessarily mean to say that things have been smooth. The Bank of England has repeatedly warned against cryptocurrencies. The FCA has recently warned about cryptocurrencies. Binance, in particular, has suffered a little bit at the hands of the FCA this year. And generally, the advice is, we have to kind of regulate it because it's an up and coming thing. So now they have released a brief statement on the tax treatment of cryptocurrencies, which basically falls in line with your capital gains tax. So the £12,300 that anyone can make in a financial year, April to April, that falls in line with this. So if you make £5,000, it will be tax free. If you make £15,000, you'll pay tax on the £2,700 that's over that, usually in the brackets of 10% according to your tax bracket. Okay. Now remember, this is just general advice. Okay. So the idea that you can make a huge fortune without paying tax is no longer the case in the UK, and it all depends on your individual circumstances and individual tax threshold. If you have a property portfolio, if you have other investments that are doing well and you sell those out, you may be liable to pay more tax than you expect on your cryptocurrency investing. Furthermore, it also means that any airdrops or anything like that you receive are also taxed differently to trading profits. Okay, and there actually is a way in the UK. There used to be a way in the UK for trading profits to be made without having to declare them through spread betting. Okay, now in the UK, spread betting of crypto assets was actually made illegal for retail traders. Okay, there is a way to trade them, but you have to prove that you are a sophisticated, high net worth trading individual who understands the risk, basically. So you can still spread bet some cryptocurrencies, but you have to jump through more hoops these days than you used to. You used to be able to log on to the majority of trading platforms. eToro is one of those platforms. Coinbase Pro is another. Okay, but you may struggle because the FCA doesn't like trading crypto derivatives, and even doesn't like trading the real spot asset. Okay, but there is a way of trading cryptocurrencies tax-free, which is to use spread betting platforms, which is unique to the UK. It's not the same in America or most other countries around the world. So there are two ways: the spot trading and the derivatives trading. Okay, and the FCA covers both. Okay, but if you make a profit using derivatives trading, you don't have to pay the tax, and obviously if you make a loss, it's not tax deductible either. So it's kind of a bit swings and roundabouts. I would always recommend trading the real genuine asset anyway, and treating this like a business. Okay, treating your trading like a business, you're investing like a business, and just deal with the profits and tax accordingly. Okay, naturally, if you want to spread bet as well simultaneously, and you want to, have a short-term time frame and a long-term time frame, then that may be more appropriate in your situation. But remember, every tax circumstance is individual. There are no blanket rules, and I would definitely recommend that you seek the advice of a qualified tax accountant in order to make sure that you are towing the line, because an investigation for crypto assets is probably going to be very, very expensive and very, very long-winded. In the US, cryptocurrencies are not considered legal tender, but cryptocurrency exchanges are legal, and but the regulation varies by state. Okay, so to give one blanket approach to tax in the US would be giving it a bit of a disservice, really. Cryptocurrency exchanges are regulated by the Bank Secrecy Act, and it varies according to the states. The CFTC, the Commodities Futures Trading Commission, has the most relaxed approach towards cryptocurrency trading and treats them as commodities as opposed to property, and allowing virtual and cryptocurrency derivatives to trade publicly on exchanges that it regulates or supervises. So that might be the obvious way in, but remember, you don't own any of the cryptocurrencies you're actually buying. You're just buying a contract, and if the exchange goes under, for example, you're trading on Robinhood or something along those lines, then your capital may very likely go with it. Okay, and obviously leverage trading, which is a whole different topic, steps into that as well, where you have to really understand what you're doing. Okay, there are extra rules in the US that they have to abide by. The travel rule, for example. So if you're funding from another company or another country, okay, the travel rule does apply, and there are strong AML and know your customer guidelines to follow to make sure that any money that's brought into the US obviously is declared. Okay, so effectively the US has more stringent but also more complicated tax situation on cryptocurrencies. Indeed, some cryptocurrencies are illegal to trade in the US, which is an ongoing situation. So let's look at some of the software that can do your tax for you. Now, Crypto.com does have a free tax product that supports Australia, the US, and Canada at the moment. Okay, no UK at the time of publication. Okay, when I used this earlier, it was actually fairly straightforward, apart from when it got to analyzing the transactions that I put through. It had 857 things that I had to check. So if you're thinking you're not going to get it done in seconds, that's probably a little bit of an overstatement. The upload that I provided didn't have anything wrong with it. This system just spat it out. I was using the US system, okay, because obviously I have no way of using the UK system at the moment, and that might change when I have a UK account through here, okay. But this is just something to keep an eye on. It will simplify the idea of generating your tax liability. However, for the time being, I'm going to use another piece of software that does allow UK reporting. Okay, so this is a summary of what I did earlier. I put 1,347 transactions between the 6th of April 2020 to April 5th 2021, which was just through one exchange, 991 deposits, 250 withdrawals, and 106 trades in total. So not a huge amount. This is my hodling account, okay? And the gains were fairly modest, almost £3,000. And I gained, it's nicely broken down here that I gained £810.58 via airdrops, okay, which are taxed differently in the UK, okay. They are treated as interest income, okay, which is taxed differently by HMRC as opposed to capital gains income, okay. So this would go under the capital gains bracket, and this would go under the income bracket, okay. And remember, if you've made any losses, this is only one account of my probably 10 accounts that I have, okay. So if you made losses, this would actually be tax deductible here, but because it's only £3,000 of my £12,300 allowance, I wouldn't actually pay any tax on this at all, provided I have not taken profits anywhere else, okay, and that includes all property, stocks and shares, even rental income, things like that, okay. So that all goes towards dividends, okay, company dividends, etc. That all goes towards your annual allowance, okay. So you can use an API. So rather than actually uploading this data that I did via an Excel spreadsheet file that I downloaded from the exchange, you can synchronize and use an API key as demonstrated in the earlier video on API keys to link this Coinly account to each other, okay, and it makes the whole process a lot easier than downloading and uploading multiple files in order to see your tax reports. Now, the good thing about that is it's very simple. The bad thing about it is that you have to keep updating them and make sure that they're active, and if they're not active, then you need to fill in the gaps, basically. So there may be a level of detective work to try and uncover this, but anyone who's run their own company or their own business for a little while and is familiar with accounting software will be able to get through this very, very quickly. All it is just collecting all of your data in one place for it to analyze and work out your liability. Further down, you are able to make tax reports and actually show these in your allowances, okay, but there are plans. You need to pay for this, okay. So at the moment, on a free plan, you can find out how much you're needing to pay, but you do need to actually, depending on the amount of transactions you actually have. So if you're a really prolific trader, you're going to be paying $279 for the report, basically, okay, or $179 if you're trading a little bit less, okay. Is it worth it? Well, yes. You know, if you are going to be trading a huge amount, $279 probably isn't the end of the world. And to have an actual piece of paper that breaks down your crypto tax liability is probably really useful if the IRS or HMRC or the government body that looks after your tax situation is coming knocking. You can get an expert review for $7.99. If you want to include it all in one go, personally, I would just reach out to an accountant who's willing to be up to speed on cryptocurrency, and you might be able to get that for a little bit cheaper than the actual amount that's recommended here. Okay, $100 is pretty steep, and also it can take a reasonable time, 4 to 6 weeks, to actually complete. So if you're doing this in the UK on January the 20th and you need it by January the 31st, that's probably not going to be appropriate in this instance. Okay, so it's a little bit more expensive. Obviously, the Crypto.com is free. Okay, so if you can work your way through that and sort out any issues, maybe you don't have any issues, then that will obviously be much more cost effective for you to do. There are also other providers out there that probably offer more competitive plans, but Coinly definitely has the majority of platforms and the majority of jurisdictions in terms of what it can offer. And if I just go to the main web page, okay, you're able to see a breakdown of everything that you've done over the past year in terms of ownership of different cryptocurrencies, and you're also able to select what market you're able to go into. Okay, so let's break down a little bit more in detail on the tax on crypto assets. HMRC have published a crypto assets manual, which you can download. I've provided a link for it in the course notes here. Okay, and if you dive into this, you'll be able to see all sorts of interesting facts that HMRC have uncovered, including why HMRC does not consider buying and selling cryptocurrencies to be gambling. Okay, so they back in 2018 they decided that was the case. It's not gambling, which is obviously good for traders like us. But you're able to boil down nitty gritty and find out what happens to exchange fees, public and private keys, different wallets, what records you need to keep, and what you need to do in terms of proof of work and proof of stake returns. Okay, there's also the definition of what are crypto assets, which isn't as straightforward as you might think. They seem to differentiate between stable coins and variable tokens like Bitcoin, Ethereum, etc. And the tax treatment may be different on each. Similarly, there may be a rule in the future where tax treatment of trades is similar to the 30-day rule that stocks and shares have. So if you trade something in 30 days, whereas if you buy and sell in 30-day window, it's treated differently for tax purposes than if you don't do it for longer. Okay. In the US, if the UK situation looks complicated, the US system is even more complicated. You may even have to go down to the individual state law that applies to your particular state. Okay, the most comprehensive is the IRS Notice 2014-21, which provides guidance for individuals and businesses on the tax treatment of transactions using virtual currencies. Okay, and if you want to have a read of that, that would tell you the general overview of the entire US approach to virtual currency taxation. Okay. Now, what if you don't live in the US or the UK? Well, there is actually a book that you can get hold of which covers 39 different countries and the tax treatment of crypto assets within those countries. Now, obviously, this was published in November 2020, so the situation may change. It may be more complicated, it may simplify, okay? But there will presumably be a second edition of this. So if you're really into it or you want to set yourself up as a crypto asset tax advisor, then this would be the book to get hold of, Taxation of Crypto Assets. Okay, and if you really want to know what the crypto circumstances are in different countries, for example, you have clients in different countries or you're advising clients in different countries in order to demonstrate your knowledge in the world of cryptocurrencies, then this would definitely be the book to get hold of. It covers sales, exchanges, receipts, forks, airdrops, mining, staking, initial coin offerings, security tokens, and initial exchange offerings. So there's really a comprehensive overview there across huge amounts of knowledge that's been gained over the last 5 years by someone at the forefront of crypto tax in the world. So let's return to the joy of tax, because obviously going through this, you'll realize how much profit you've made, how much of a loss you've made, and ultimately how much you're communicating and contributing with the government. Now, obviously, the whole government situation with cryptocurrencies is a little bit odd. Okay, they are slightly anachronistic in their establishment. Okay, cryptocurrencies were designed to exist without governments, but for the time being, We're going to have to continue paying our taxes in order to avoid prison and worse, etc. In some parts of the world, not paying tax is a very serious affair indeed. In the UK and the US, you're probably going to be okay for a little while as long as you keep paying what's owed, okay? But having a real handle on your tax situation and your profit and loss really can help you, make you feel like you're running a cryptocurrency investing business, and really know how much risk you can take, how much trading losses you can take, etc. And the more you know about your tax circumstances, the more you'll know ultimately about how much profit you can make and how much you can actually trade on a day-to-day basis.